What's up, guys? It's Pac. Welcome to video 3, how to choose the right zone to trade from. Now, in this video, we're very simply going to talk about zones that are mitigated compared to zones that are unmitigated. Okay, zones that are mitigated, all that means is that they've been used. Mitigation, all that means is to collect. So orders have already been collected there. So if they're unmitigated, that means orders have not been collected in that area yet. So where do we want to trade from? Very simply, we want to try to trade from the areas that have been unmitigated. Now, there is a couple nuances within this that I'll go over in this video, such as the top and bottom of the zone and the 50% rule that I use to determine if a zone is truly mitigated or if it's truly unmitigated, and where I can take my trades from. Let's hop right into it. So what we'll go over here is what is mitigated and what is unmitigated. Again, as previously stated, to me, for a zone to be mitigated and for me to expect it not to be used again, which there is a nuance, zones will be used multiple times in certain scenarios. But for a zone to be considered mitigated, we need to have used that zone at least to the 50% mark of that zone. So what would that look like? Well, we clearly have this uptrend here. And we have our last swing points in the uptrend. And you can very clearly see that this last swing here came down into the 50% of this swing point. So if price were to start trading down, I would not expect this zone that we currently have to hold and produce another bounce. Okay, that's very, very simple. Very, very simple. Same as this zone up here. You can very clearly see that price has come down to 50%. And so if price decides to trade down, I would not expect this zone to hold price and send it higher. Now, that doesn't mean we can't get a little bounce and continuation down, but I'm not expecting this to push price higher. So what does an unmitigation look like? Well, an unmitigation simply would look like a zone that has not touched at least 50% of, or if price has not touched at least 50% of the previous swing point. So we can very clearly see a swing point here, and I'll put this in blue. That price has not been traded below or traded into. So what do you typically see in this type of scenario? Well, you'll typically see price trade all the way down to here, mitigate it somewhere, and then continue this way. So in this expectation, because I know where price needs to go because of the unmitigated areas, I know that we're still bullish even when price comes down here, even if it's switched structure. A lot of people will be like, oh, switch structure, something in here, short, 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 just for this thing to get you just completely wrecked and smoked. So that's very simple on what mitigations and unmitigations look like. It's very, very simple to see. Did it hit 50% or did it not hit 50%? That's the first rule, the 50% rule. The second rule is if we have a swing point, and let me just draw a very simple swing point here. We did dig into the swing point, but we've yet to use 50%. We've yet to use 50%. So if this leg that starts pushing up higher, if we fail to use 50%, we use something just above it, and we fail to put in a new high right here, what we can expect is that, say price fails to get up there and it starts trading back down again, we can expect it to disregard the 50 and tap in just below the 50 and then attempt to make a new high or low depending on the direction that we're looking at. A lot of times you'll see something like this. Even if price decides, hey, we're going to barely tap it and make a new high, when price starts coming down here, I'm still expecting a bounce deeper in this swing point. Why? Because we haven't used the 50% yet. So just keep this in mind. If we haven't used the 50%, but we give a bounce away, When we trade back into this zone, we're not bouncing at the 50 in majority of cases. We'll bounce at something just below, which typically ends up being the origin of our move in most cases. So those are my two rules for mitigations and unmitigations. Very simple. If price is not used at least 50% of the swing point, keep it on your chart because there's a very good likelihood that price is going to come back and use that later on. Maybe today, maybe tomorrow, maybe next week, maybe next month, maybe next year. But at some point it will come back and use that zone because it is unmitigated until it hits 50%. Let's look at some examples. So this is from today's price action, which is Tuesday, March 19th, 2024. And as we're marking out our swing points, we'll remember that this was our 1 minute structure coming into today. 1 minute structure, we had one there, we had one there. We had structure form here, and there, and there, and there, and there. We had a flip of structure here. Low there. Push back up there. High there. Flip back down there. Trade back up there. And there, and there, and there. And that'll be good. That'll be good. Okay. So that's our structure. So keep that in mind. I'm going to get rid of all these drawings and we're going to start putting in the swing points. So for example, we had a point here that got touched at least 50% here. And you'll notice as I draw this away, once we cross that high, we don't regard the 50% again. This is a point where, yes, we bounced off of it here, but I'm not looking to take a trade here because I know that we've already mitigated this 50%. So I know that the likelihood of this point pushing a new low is very, very unlikely. So I know that the move coming out of here is shorter, especially since we flipped structure already in here. But you can very clearly see 50% mitigated. It runs straight through the zone. Let's see another example of 50% mitigated, then it gets ran through. 50% mitigated, tries to push away, fails, runs straight through the zone. Cool. Let's see another example. There's one right here. There is a zone right here as we're coming down. We tapped it, 50%, failed to put in a new high. What happened? It trades right through the zone. Very, very cool. Very simple. Here's another example of 50% mitigations. There's a zone here. It looks like we only played off around a little bit higher than 50, so we were expecting to see if the price gives a bounce here. It did not. Actually, I was watching this live. It gave a little bit of a bounce. It failed, continued lower, right? Let's see another example of a 50% of a swing point, then failure. Let's see if there's one up here. I'm sure there is. Yeah, here we go. That gives you that gives you about 50%. We trade out of it, we trade back in, it fails, it runs straight through. Here's another swing point. Nope, that's not one. Let's see if we got some more examples over here. Trying to look at the 50. Oh, here you go. Here's one. Here's a good one. You can see we bounced at the 50, failed to put in a new low. We come out, there's some reaction, but it runs pretty much straight through that zone. Here's a swing point on the 144 minute. You see as we trade below, we traded back up to 50%. It looks like we're failing to put a new low. So the expectation would be that we start digging deeper in the zone, possibly even running it. Okay. So let's see, here's another swing point here. We'll do this one here. You can see we came down. It looks like we tried to tap a little bit lower. We tapped around 50. It gave a little bounce here, right? It gave a little bounce. It failed. We continued lower. It tried to bounce at the bottom. It's failed, and then you'll see it runs that low. Runs all the way through. Here's one. Here's a swing point. And you'll see this one didn't hit 50%, but it's hit the SNDR that ends up sending us over this break. So here's one that pushed us. So now what's the expectation when we start coming to this low? If we trade back down here at any point, because to me this is still an unmitigated zone, we should disregard the 50 and you'll see a bounce somewhere around here around the 1700s. That is very simply what unmitigations are and mitigations are, and the zones that you start looking towards and how you should start thinking about these zones. This should be a fairly short video, so we're about to move on to video 4, but you're going to look at, has this zone been used by at least 50% or has it been used at all? If it's been used at all but not 50%, okay, we'll expect a deeper mitigation. And if it's used 50%, most expectations is that that low or high is going to be ran at some point if it's already been used 50% and fails to put in that new higher low. Very, very simple. Let's move on. Video 4.